No, say hi.
Hi.
Hi, everyone. I'm not sure where I'm meant to be looking. There you go. That's up there. Different cameras. Good evening, everyone. My name is Simon Misiewicz, and
I'm Louise Misiewicz.
the better half, apparently. We'll test that theory. So thank you ever so much for tuning in. We're just going to let everyone else join in. I can see that I can't see those numbers, so I think it's 32. So
Awesome.
we're expecting a lot more people to be joining us tonight for the webinar.
And boy, do we need to get on with this stuff tonight. There's a lot to unpack and a lot to deliver.
Yeah, it feels like there was a lot to talk about in terms of our slides, but there wasn't that much as an update in the budget, I felt. It wasn't as though they're trying to attack so many different things. So what I would suggest is for you all to think about what you've seen, and maybe just type in a few words of what you think of the budget that you've heard. We are going to go into detail ourselves, but why not just type in a few lines talking about what you have seen and what you think about the budget from your perspective. This is affecting me in this way, and I like it, I don't like it. Something like that, just to kick us off, if you like.
And anything that's particularly worrying you or that you would like to cover. So if you can just keep those to very short sentences or a couple of words or phrase, then we'll do our best to answer those questions. We've got a lot to cover tonight, genuinely. We have a lot to discuss in terms of how to resolve some of the issues that are coming out from today. We've called it Beat the Budget, basically. It's a nifty little name for a game show, I reckon. And it felt a bit like a game show today, to be honest, team. But let's cover that later. So come on then, let's see some notes.
Dave Driver already said, I'd rather not have had to stare at Rachel from accounts while I waited. Yeah. Anyway, so just thought that was amusing. So why don't we kick off? I think it's 2 minutes to normally we start at 8:05, but there's so much. I think we should just kick off.
It would be lovely to start. Is that all right with you guys? Type in yes in the inbox if that's okay.
Yeah. And what I'll do, not yet, Simon, but I'm going to make happen. Okay, Simon Collins, I was asking if he's left the UK yet. I know in the last budget he talks about it. So let's kick off with some of the updates. So this is the basic budget update, and Louise has called this Beat the Budget. So let's, why don't you make us change? Why don't you run through these slides?
Okay, so basically the format tonight is really going to be in 3 sections, if Simon's left my slides as I expected. First is what's changed, what's happened.
My slides.
Well, absolutely.
I mean, here we go, kicking off already. Look, my slides.
So before I was so rudely interrupted, what's changed? What's happened today? What are the key highlights? Then how could it impact you? So our thoughts on what we're seeing for people based on our insights and knowledge of working with all the many lovely people we do, and then what you can actually do about it. So, and we called it stage 1 because, you know, today we spent a lot of time following Rachel's announcements, thinking about, reviewing together, discussing, identifying ways to help mitigate some of this content, if not nearly all of the content. And there are ways to mitigate this, team.
Well, let's not spoil it.
No,
so let's crack.
But because there's so many, we've kept it to stage 1.
Yeah.
So there are more stages, but tonight's stage 1.
Yeah. Okay. Let's just, if you want to discuss our services, by the way, the links are in the description box below. But if you have your camera, use that now. If you're on your phone, you won't be able to do that, but it will be in the description box. There's a QR code. Take a picture or screenshot or whatever. Discuss our services. See how we can help you reduce your tax liability. There are a number of clients on this call, obviously, tonight, as you would expect because of the budget announcement. But let's go through the high-level changes that we're going to be covering off tonight. And some people have already said this, actually. It seems to be that private investors are hit, not really professionals. And I'm going to go on to say, actually, is a tax attack on investors. You're right, whether it's savers, property, and shares. So it's definitely, I agree with you. There is an attack on investors, not much else on else. The other one was tax on wealthy, which Louise put a line for it. I'll let you explain that.
Okay, So for me, I felt that Rachel was trying to position she was after those with more wealth. And I think I can see that very clearly. But I actually feel that there is this undertone that actually she's attacking everyone. Fairer for everyone? No, I really don't think so, Rachel. There are very different ways we could have gone about that, in our opinion. But actually what she's done is she's attacked everybody in different ways. And we'll come on to that later.
I thought the way you script that out, I was back at school and you had your green pen. You're not allowed red pen apparently nowadays.
Purple for polishing.
That's all right. Yeah, different colors. Right. So that's what I thought it was. It's just a correction, but it's not, of course. If you are new to Optimize and you want a property tax ebook that you can download for free, then feel free again to use that QR code. The link won't be in the description box because we're leaving those links for events and for you to book appointments with us. So make sure that you use that QR code to download your property tax ebook. A lot of these QR codes will be shown on screen multiple times throughout this evening. So if you missed it, don't worry, you can always get that, or you can just go back on your video. Okay, so why don't you run through these ones? And then
okay, so this really starts to answer for me some of those points around tax on everybody. The first one is that income tax band freeze that will now be in place for 10, yes, you heard it right, 10 full years. They first came in 2021 and they will be with us until 2031, which is just ridiculous. What this is doing is, in many ways, and I absolutely get why it's being described as this, it's a stealth tax. To my eyes, it's an absolute raid. And what it's doing is it's pushing more and more people as inflation causes all sorts of things to go up, thankfully to a degree, some salaries. But unfortunately, that comes with quite a painful jolt because you may find yourself jumping into the next upper level of tax without really benefiting from what you thought would be a higher rate or an additional rate taxpayer's position. You may even find yourself picking up tax for the first time if you've been really careful and managed your incomes in such a way that you haven't paid tax historically. This alone will attack hundreds of thousands of people over the next few years. And I think it's bad in all sorts of ways. Let
me just add to that, because one thing that Rachel Reeves said is that she's not going to affect income tax. Well, she's lied, because Absolutely. This clearly does, because everything else is increasing with inflation. And by the way, type in the box if you agree or disagree. Has changing freezing the personal tax bands actually been an indirect impact on income tax rates? I believe it is. And when she said that she's not going to attack it, I disagree. She's frozen the income tax bands, personal allowances, and therefore it must attack people's income tax bands naturally.
We did some calculations early this afternoon to identify at what point you would start to pay tax. And if you are an 18 to 21-year-old on the new level of the basic wage that you must be allowed from next year, you only have to do something like 18 hours a week and you're already into a tax bracket.
Next one.
Next one, frozen NIC bands. Of course, alongside that income tax freeze, there is also national insurance contribution freeze. What does that mean? It means you start paying national insurance contributions possibly a lot earlier than you expected as your salary perhaps increases. Big problems there. And then connected to all of that is the frozen Plan 2 student loan threshold, which basically means as your income grows, although it might only grow by a modicum, you may find yourself suddenly starting to have to pay back that student loan a lot faster and a lot earlier than you actually expected.
So that's a double whammy, really, because you might be pushed into the higher tax band whilst having to pay that student band as well. So double whammy. Again, like I say, throughout these slides, you will see as these QR codes. If you're not a client of ours, Discuss Our Services is a great way for you to find out how we can help you. There's obviously a lot of changes. We can help you mitigate taxation. That's what we're here to do.
But also importantly, for you who are with us this evening and are our clients, you know what to do next. If you have questions, if you know that it's going to affect you and you want to review how best to mitigate this as fast as humanly possible, book those tax consultations in with your account managers. They're there ready to discuss this and work out what's best for you that's specific to you.
I've just got a question from Dave Driver saying, when's the webinar going to start? It started, Dave. Hopefully you're on it. The internet's not blown up for you. Okay, So,
in fact, with that note, can you all hear us? Please type in yes or no.
yeah, a lot of people saying agree, so they're answering our
Okay,
question.
good.
So I think it's just Dave, I think. In regards to income tax non-savers, so we're not talking about those that are saving for the future, putting into savings accounts, ISAs, or pensions. We're not talking about them. We're talking about everyday working people. And I think the Labour Party's mantra has played out, because one of the things that they said was, we're not going to affect working people. I'm referencing PAYE. So if you're, and someone else has said this as well, saying if you're a professional, you are probably safeguarded. But if you're an investor, an entrepreneur, you are going to be affected. So it goes out like no changes, none whatsoever. So what has changed? Well, let me tell you now straight away. The big change for me is this slide. We're talking about interest, and we will be focusing on landlords later on. So please do bear with us. There is a whole slew of information about this. I'll pick this one up because this is nice and easy. Income tax, if you're a saver, bank accounts, normally we talk about interest from your savings accounts. Basic rate tax band for you is 20%. PAYE remains at 20%. But if you're a saver, you are going to pick up a 22% tax band for basic rate taxpayers, anyone earning up to £50,270. As a high rate taxpayer, you're going from 40% to 42%. And then additional rate taxpayers are moving from 45% to 47%. We're nearing a 50% tax band. I mean, this is just crazy, right?
And couple that to those thresholds now being stuck.
Yeah. And I think this is where a lot of people are feeling, hold on a minute. We've been asked to put into money into pensions, which we'll come on about later on. We've been told to put money into savings accounts to save for a rainy day. And now we're being hit with tax rates. It does feel as though they're putting up a thumb in the eye. There's the property ebook. So if you want to download that again, there it is. So feel free to get that. All right, so let's talk about Savers Beat the Budget, stage one. Lou, kick us off.
Okay, so some of these things might be things that you'd already been thinking about. So let's just nail some of these really important points. The first is, albeit I appreciate that some of the ISA content has changed, and again, we'll come on to that in a little while, but ISAs, rather than general bank savings accounts, are the first things you should be maxing out each year if you are looking to put money into bank accounts for interest. That's because ISAs still, of course, remain completely tax-free. Now, there have been some limits on the amount, but let's put that to the side. The important thing is max out your ISA before you're maxing out other bank accounts. The next thing is, if you can, think about how your savings allowance can be maxed each year so that you are taking advantage where you have money that is not in an ISA or a tax-free allowance set. Think about how you're using your bank accounts to make sure your interest is tax-free. Rachel hasn't taken away, this time at least, the savings allowance. And depending upon whether you're a basic rate or high rate taxpayer, you may have some money that you can earn completely tax-free on interest. Absolutely max it out, but only max it out. Don't go beyond it. Again, back to my point, go to ISAs if you can.
Yeah, and someone's asked the question, has the £500 tax-free allowance? I mean, the tax-free allowance for interest is £1,000 if you're a basic rate taxpayer and £500 for high rate taxpayers. And I don't think that's been changed at all. Next one.
Okay, so then finally, if you're doing all those things, have you done it for the both of you if you are married or in a civil relationships? Think about how you're both doing this to give yourselves the best boost you can. So don't think about it just for you, think about it for everybody in your family, quite frankly, and make sure that you are maximizing those opportunities wherever you can.
And there's our discuss our services. So if you're troubled by all this and you're not an existing client, which a lot of people on here are clients of ours, then if you're not, feel free to book a call with us. Ask your questions time. So if you want to ask your questions, feel free to do so. We'll run to the questions that I see here. If you are watching this video and it's good, getting good content, please hit that subscribe button, please. That's all we ask of you. We're not asking you to do a £5 chat for us to answer your questions. We will answer your questions. And equally, press like on that like button, please. That'd be great, just so we can get the algorithm going on YouTube. Thank you ever so much. So, in fact, there should be a way to see if we can get subscriber-only comments. But anyway, we'll come back to that. Okay. David's just said, I see a static screen. I think it's only you, Dave, or may not be just you, but I think everyone else is seeing the live screen. So hopefully you might be able to get your technology. If it's broadband issues, then maybe you can rewatch this. So don't worry, you'll be able to watch it. We talked about that already. Here's a question for us. And it says here, does the ISA also include share ISA, or is it just referring to cash ISA?
So clearly, if you are focused on bank accounts, and again, I'm not going to go into it just now, there's a certain amount of your ISA allowance every year that you can put straight into bank accounts. So if you are thinking about, I want interest, not necessarily dividends, then of course, definitely use the bank ISA element. But the ISAs haven't changed in the sense that they are a combination of different types of ISAs, some of them being cash as an example, and some of them being stocks and shares. What is changing is the amount you can put in either one of those, but we'll come on to that later.
Okay, there's a comment up here, which I'm just going to grab back, actually. And it just says here, Saf FB says, I think you younger generation are being particularly hit by this budget. And I think probably referencing the personal allowance. I think that's probably what that's referencing. And I would agree with you. I think everyone's been really affected by that. Dave is back on. So great news,
Hooray!
Dave.
Welcome, Dave.
Welcome back. Okay, so there's no other questions just yet, but thank you for your kind comments. What we'll do is we'll go to the next slide and then we'll pick up. By the way, thank you ever so much for those that have pressed the like button. We're up to 21 out of 75 though. Not sure what to think about.
There's an opportunity there.
But whilst we're waiting, why don't we just see if we can touch that out to 25?
Don't be as mean as Rachel.
Yeah, go on.
Give us those thumbs up. Come on.
Okay, so we are running an offer tonight for non-clients. If you are a client of ours and you're wondering about what this means to you, we will be sending out an email to you in the next couple of days. You'll also then be invited to speak to us if anything in particular is going to affect you immediately. Most of these tax changes don't really come into effect until next year. It's not as though she's done with immediate effect like she did with the stamp duty. Remember that? She's not done that with a lot of these things. It's all for next year. But if you are not a client of ours and you want a tax consultation, the links will be in the description box below. But if you want an hour with us, the price we're reducing from $299.95 to $194.97. All you need to use is that QR code or the link in the description box below and use the code U35 to get the code. Equally, if you're thinking, well, actually, I do still want to invest in property and a limited company is the best thing for me, but I don't want to set it up myself because let's be fair about it. If you're paying £12 to £15 to set up a company, it's probably not that very good. So if you want to set up a UK limited company in the right way and get tax advice whilst you're doing it, then maybe you can use that QR code. Again, the link will be in the description box below. From $399.95 down to $259.97. We can't say fairer than that. The code is U35. The offers will run out Friday, 28th of November. So if you're watching this on Saturday, sorry guys, these offers are only on the cards for this show and for the next couple of days. So get in there as quickly as possible. The links will be in the description box below.
So booking it before that date is the key thing. Having to host a session before that date is not the key thing. To get that price, you need to book your slot, whenever that slot is, before the end of Friday, just to be clear. For our current clients, as Simon said, you're going to be getting a detailed handout, for want of a better phrase, sent to you via email, which will cover stage 1 and stage 2 opportunities to save. And like we say, if you want to get into the detail, and I'd love you to do so, then to get that stage 3 detail, which is specific to you, book your time with your account managers. You know, that's part and parcel of the service as a current client. Please do it. We really want you to not pay these awful taxes as much as possible.
Good reminder. Yeah, good reminder. Okay, let's go to landlord focus. I'll pick this one up because this has really been quite a pertinent one for my observations today. Section 24 still applies. So mortgage interest relief. Remember that? Many years ago, the whole idea of having mortgage interest as a cost, it's a cost to us, right? And yet we've got to discard it. That is crazy. No other country does this. Removal of furnished holiday let tax reliefs, relievers. Did we change that?
We did.
Okay. Why relievers?
Because there's more than one.
Okay. So holiday tax relievers was abolished. We also had the removal of the 10% wear and tear previously to that. Now we've got this additional 2% tax. So have landlords just been targeted time and time again? Those that are not investing inside of a limited company. I think it's fair to say you have. There's that discuss our services. Let's go into a bit more detail about this. Why I think landlords are still being targeted. And I think the Labour Party are missing the point about what we do, what you do as landlords by providing accommodation to those that do not want to buy in the UK or cannot afford to buy in the UK. And yet, landlords are being targeted.
First things you might want to do to help lessen the pain of that horrible mortgage interest relief calculation that's been around since 2017 is to pay off those mortgages. Now, you may already be doing that and planning to do that, but can you speed it up? That would be one of the first things that we look at to assist you in determining if that's the best solution. The third and funny, odd one, I would say, is actually no longer having property. That sounds a really strange thing to be saying, I'm sure, but perhaps this is an opportunity for you to reflect upon your entire portfolio and identify if there are any properties that actually are really low in yield to you in terms of the money they're generating on the money you've invested. Perhaps it's an opportunity, particularly if the capital gains tax at sale of those assets wouldn't cost you too much. Perhaps now is the time to offload those assets and buy different assets, maybe more property, but actually perhaps there's an opportunity now to start investing, for example, through that first set of ideas that we showed you, which was through ISAs. So now is the time to start looking at your individual property by property yields and determine if there's something you can do about those that are no longer performing to the standard you expect. Finally, and this is going to be a common theme of mine, spouses. Think about how those assets are owned and how, more importantly, the income is owned between you, and make sure you're taking advantage if there's an opportunity to reposition the income and the asset between a low rate taxpayer and a high rate taxpayer. Clearly, we're looking to shift it away from the high rate taxpayer wherever possible. There are ways you can do that, and there are ways you can do that really quite quickly without necessarily costing you an arm and a leg, unlike Rachel's plans for you, of course. So please don't forget to look at what you're doing with your spouses and civil partners in terms of how you're owning these assets and if there is a differential between the tax rates between you.
Okay, time for asking your questions. And of course, don't forget to press that subscribe button. Hopefully you have. We've got some more likes. We're up to 38 now.
38, that's amazing, but we're looking for more.
We are
Bring
looking
them
for
on.
more. So please, 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 if you're getting value out of this just by having this conversation and maybe just airing your thoughts out, maybe that's good enough for a like. I don't know. Okay, so let's get some questions on the road. And there was a couple of questions. I'm just going to go up because there's quite a few.
Oh, you're all saying criminal. Couldn't agree with you more. I think it's Rachel Thieves, not Rachel Reeves, quite frankly.
Okay, let me just. Okay, so this one maybe for you, Louise, to think about.
Okay.
I get my property income as a beneficiary of a trust holding rental property. Will this income also be caught by the 2% supplement? I think it will be, right?
We think it will be, but interesting enough, that the angels are always in the detail, are they not? And right now, all that has been released to us is some very basic sets of notes, and of course the speech that she shared pretty much verbatim. As is usual, there is very little detail, and we were laughing rather cynically earlier because there was one of those that had less than 3/4 of an A4 page in terms of describing this new tax that was going to be imposed upon us, and it literally said, for more information, we'll share sometime before 2029. What? So right now we can't answer that question, but perhaps that's something to book some time with us on if you're not a current client in the next month or so that we can give you the answers to that once we start to see that detail fleshed out.
And Dave has asked a question, which I think is pertinent to everyone else. Let me just make sure it's the same one. Yep. So Dave, a current client, so make sure you book a call with your account manager, Dave. And I'm also going to be speaking to Peter Curley, Simon Collins, and a few others that I'm seeing on here as well. Please, please, please do reach out to your account manager. If you're on here and you're thinking, okay, maybe I need to change strategy, maybe I should do this, you've got access to your account manager. They're fully qualified. They're going to be able to help you. So make sure you do that. But to answer this question, I've bought my property in my name ever since Section 24, or even people that have bought property before Section 24. What we've shared with you is pretty much the main things, right? Pay off your mortgage, big thing. Don't keep on buying more properties, adding fuel to the fire. What you want to do is stop paying the banks. £30,000 in this example. That money could be yours. So stop doing that, because the return on investment, what's return on investment when it's a minus number? A negative. So there, and your bank interest, 6, 7, 8% maybe. Probably not as high as 8, but nevertheless, it's probably still at least 6, I would say now. That is return that you could be making by not paying the bank. So one of the strategies, sorry, a bit fluffy there, but one of the things I would be saying is pay the bank back and have that money for yourself. But for everything else, Dave, there is the opportunity to speak to your account manager. So do that.
While Simon's looking for the next question, I'll just add to that, if I may. We've done quite a lot of support to clients thinking about restructuring their portfolios in their personal name. And one of those is an example, and it's a genuine example. Of course, I have to keep it anonymous for confidentiality reasons, but we had a client with only circa 9 to 12 properties, a lot of properties. And some of you may be only just starting out on this journey. Some of you may never want to have that many, but this client had that number, and the majority of them were relatively heavily financed. They identified, interesting enough, some assets that were really quite low yield. They had not performed for a long time and probably wouldn't, based on some changes that occurred in their marketplace. With our help, they were able to identify that through the sale of 2 or 3 of those assets and using the money released to pay off the mortgages, they could nearly double the amount of income they had after tax.
Yeah.
These are really important points. Do not ignore them, because there are opportunities here. And you may be emotionally attached to 1 or 2 properties that actually you should have let go a while ago. And you know it, but you haven't. But let that be at least a glimmer of opportunity for you, that there could be things there hiding, just waiting to be exposed by you to give you much better income.
And just goes back to my point I said earlier about the level of interest that you're paying out. That's the return investment that you're losing. And whilst you're constantly looking for new investments to make, that's another boiler to maintain, another tenant to maintain. You probably are now in a better position to pay off the mortgages, have less tenants, less boilers, and have more profit, is my words on that one. There's a point that I think Cameron was saying about, do you think it's prudent to incorporate property portfolio? No, I do not. We're not going to go to the reasons why we do not, but if you just type in the Dan Needle into Google and then property incorporation, I'll let you do that research. I won't go into that for this webinar. I already have made the appointment. So Dave, very proactive. Good to see. Well done,
I'm
mate.
giving you a thumbs up in return for your thumbs up. Well done. Can't wait to make sure you're not paying all this awful tax out to Rachel and her team. I nearly used a different word then. I'm so glad I didn't.
And someone else is saying, Simon Collins is going to be speaking with Lynette, which
awesome
is good, right? if you're a client, reach out to us, because that's what your service is all about, giving you comfort and confidence what you're doing. All right, let's get into the next batch of slides then.
We are 36 minutes into our 60-minute session, people. I hope you're getting some value out of this.
Yeah. And by the way, if you're not a client of ours and you need some advice right now, or you want to set up a limited company, don't forget these QR codes. There's 35% discount being offered for between now and Friday, but they will not be there after Friday. And we're not going to be doing a webinar until January. So we won't be doing any promotions until that point. Sorry, my dog is now snoring. So training thoughts. Yes, use the QR codes. The links will also be in the description box below. All right, let's talk about limited companies. I mean, one of the things that I'm going to be talking about next year is something called the growth model, which is, if you're a client, by the way, and I'll talk about Dave, I'll talk about Simon, I'll talk about, who else was there on my list? Peter, sorry. Then, we're going to be launching a new product service. No extra cost, by the way, for our existing clients, but we will be talking about growth platforms. I'm going to share with you some of my own personal investment strategies, all the deep analysis that I'm doing for my company, for me personally. I want to share that with you. And then we're going to be doing some live sessions like we are doing now. And Louise will be supporting us as well to go through some extra details that I may not be able to cover. And part of that is going to be ICO, investment companies. Keep that in your mind's eye, because in 2026, we're going to be talking about that an awful lot. So in the meantime, let's talk about income tax. I'll cover this, and then you do through your
keep going. Let's do it.
So going back to the comment that someone else has already made, that if you're a professional, you're not really being affected, or if you're a PAYE, you're not affected with these tax changes. But again, entrepreneurs, people that want to invest for their futures and build a business, you are affected. So in this case, we've got income tax on dividends. As a basic rate taxpayer, it's 8.75%, but next year it's going to go up to 10.75%. High rate taxpayers, it's 33.75, going up to 35.75 next year. Weirdly, even though we thought that she's attacking the wealthy, the additional rate taxpayers' current income tax on dividends is 39.35%. I couldn't see that going up. Now, maybe that's just a misprint. Maybe she did mean to put that up, but I didn't see anything on there just yet. So we will come back to that at some point.
And her script specifically excluded any change to additional rate. Let's see how much that changes between now and when she puts the legislation in place.
Yeah. Amelia, you've just been asking, can I speak to my account manager? Yes, of course. You probably won't be able to speak to you, but I will be joining for my SA in February. Yeah, Amelia, of course you can, right? That's what we're here for. So please don't hesitate. Get in there. So what is the total tax? Now, I've made this the worst case scenario, and I always like to do this because at least it gives us an indication of where we're all going. So if you're a high rate taxpayer, someone earning more than £50,270, or an additional rate taxpayer. Now, if you've got a limited company, the top tax rates in a company is 25%. So if you're earning £250,000 or more, you're hit with this 25%. Anything below is anything between 19% all the way up to 25%. But over £250,000, we all want to be successful. We want big companies. We want to take maximum dividends, etc. So corporation tax is 25%. The dividend tax is 35.75%. For high rate taxpayers in the future, next year. Additional rate taxpayers, still 39.35%. But interesting enough, when you add those two numbers together, these numbers are shocking, absolutely shocking. And if you think this is shocking, just type in the word shocking in the description box, because I'd be interested to know, would you ever have thought about paying 64.35% tax to a government that says, hey, we don't mind people not working and have 20 kids, and we'll pay them all the money while you're working, slogging your guts out. Yeah, you need to pay 64.35% for all those people. I don't think that's fair.
£100 of hard-earned profit, and all you're going to pull out as an additional rate taxpayer is a measly 35 point something percent. Hang on. Is that right?
Yeah, shocking, right? Shocking. If you think it's shocking, you type shocking, because I'm horrified that the way that she's taking the cap off to say, hey, if you've got more than 2 kids, we'll keep on paying you. So don't work. Sorry, what's the phrase that is? Can't work, won't work. And then have as many kids. We had that before, and it was a broken system. And yet the Labour Party are dragging us back into it again. I'm fuming, and I'm sure you are, if paying 64.35% for other people that just don't want to work. I think that's just shocking. So there, anyway, there you are. So beat the budget. Lou, how can people beat the budget?
So the first thing you need to do is to plan. As the old phrase used to say, fail to plan, or rather plan to fail and fail to plan. You've got to think through these things really carefully. And my suggestion is, irrespective of when your company year end is, think about interim dividends towards the end of March. Clearly do it so that you know all the different incomes that you've got coming through the door, so that you can make sure you don't mistakenly force yourself into a higher rate tax position, jump a band, and suddenly find yourself on the sharper end of maybe 5, 7, 10% more than you were expecting, because you happen to want to take some dividends. You could have held off, but you thought it was the right thing to do. Plan it carefully. That's one thing that we are so keen that our clients do with us. And it's one of the reasons that we want to talk to our clients at all sorts of points during the year, but in particular, just before the end of a personal tax year, which of course, you know, is the 5th of April every year, hence why we want to talk in March. So be careful, plan carefully. Also, review your salary withdrawal. So if you're in a position where you're taking the money out of your business, think very carefully about how much you're taking. If you have multiple businesses, and we've seen this with clients already, we're not picking on you, we're just saying we've seen it and we therefore need to guard against it and help you guard against it. Be careful you're not taking some salary from here, some salary from there, and you're certain it's pretty much within those bands. And then suddenly you find yourself where you've actually taken a lot more than you were expecting, and it really shouldn't have been down to salary. Mm-hmm. We see this time and time again, and we're really doing our best to work with our clients to prevent that. And I know you guys want to prevent that too. So think about that very carefully. Then also think about pension contributions from your company. So if it is your business and you can determine the scale of the pension contribution you want to make into your pension pot directly from your employer rather than you as the employee, this is still a really good way to go. Rachel has not affected this element at this point. I do feel like I keep saying at this point, goodness knows what she's going to throw at us, because of course she wasn't going to tax us this year, was she? Moving on, pension contributions, that's the next big thing to think about. Not only are you therefore helping to plan for your future, you're also minimizing your corporation tax. And if you don't understand that element, book some time with us so we can help you. Finally, if you are really interested in this investment idea, but actually you don't want to withdraw the money from your company, even though ISAs sound great, you know withdrawing that money is going to cause you personal tax, why aren't you making those investments in your company? Let's think about these things really carefully. In some cases, in a lot of cases, and believe us, we've done a lot of tax research on this, dividends landing in your company are actually potentially free of corporation tax. So you've got to be really savvy on these points, and we can help you with that as well.
And let's not forget the 3 letters you should be remembering is ICO, because that's going to be huge in 2026. Everyone talks about fixed, everyone talks about family investment companies. ICO will be bigger and better. I promise you that. Okay, and I think there's a message actually from Saf B, who's asked about the point about creating a company. We don't do family investment companies. We do work with companies. So reach out to us through info@optimizeaccountants.co.uk. We can put you in contact with someone who does family investment companies, but you are looking at least £5,000 to £10,000 to set those things up. The question is, do you really need a family investment company? Not always people do, if I'm totally honest with you. Okay, again, free property ebook for you to download. There's a QR code. Pause the screen if you want to get that on your phone. The link won't be in the bottom, so make sure you get that QR code here. I'm going to go to questions now, so don't forget to press the subscribe button and the like button if you don't mind. We're up to 46 now. So
46.
Very good. Yeah,
I think there's room for a few more in there, isn't there?
I think someone's mouse isn't working.
Oh, maybe they just need to change it.
I think that it happens. If you use your keyboard, though, I think it still works with your
Amazing.
keyboard. So do that. Just give it a nice like. That would be good. Someone's asked a question, what does ICO stand for? Investment company. So it's simple as that. But it's not about the share structures, because an investment company, it's what it does, how it invests, and then how you generate wealth. That's the big thing for 2026 I want to talk to you about. I'm still doing an awful lot of research yet.
Generating that wealth really tax efficiently.
Okay, so questions wise, I didn't think there's any questions in here.
You've got no questions for us.
I know, right? I think it was pretty much Dave's third question. I'm not going to put it on screen. He did say, I don't have a spouse. Can I transfer some properties to the cat?
What a wonderful idea.
Oh, yeah, that's fair, isn't it? I mean, you know, if you need a feline, then the feline needs a place to stay. Why don't you just give the cat a place to stay?
Absolutely.
Curious about ICO. Yeah, that is definitely something. Well, can you share more information about ICO, please? No. Sorry.
You're going to have to.
You're going to have to comment. You're going to have to clue back in 2026. ICO is going to be bigger than smart companies. Sorry, Mark Alexander, but it is going to be bigger than that. It's going to be bigger than Fix. It's going to be huge in terms of the way we invest and how we can do it tax efficiently as well. It's going to be significant. So stay tuned for that.
And the good news is 2026 is only 34 days away.
Yeah, exactly, right. Well, but we've got the tax returns to get through, right? So February, we're launching Growth. Growth is where we're going to introduce ICO for the first time. Okay, so in terms of the IUS, I'm not sure, GTX, what you mean by that. IUS property worth it? Oh, is property worth it? Yes, I guess. Sorry, I just read it. Yes, it is. Listen, anyone who keeps saying is buy till it's dead and you're going to get this all over the place. Let me give you some honest statistics. First of all, not everyone can afford to buy a home. Second of all, divorces are now at 65%. So when people split, one of them is going to go to a rented accommodation. Third thing, not everyone wants to buy in the UK. Fourth thing, sometimes people have a job in one location and then rents in another location. We've done that for an awful lot of doctors and people that lived in London and needed a place to stay in Nottingham whilst they work at the hospital. Those things would suggest that landlords are in need. And by the way, whilst all those amateur landlords are leaving, what does that mean for you professional landlords? You're going to be putting up all your rents because the demand is there, the supply is getting less, and Rachel Reeves can keep her mitts off because ultimately you're just going to give that to the tenants. She forgets this, right? She says, oh, the tenants are poor, they need this. She completely forgets, quite ignorantly, that any increases in taxes will be passed on to the tenant. Simple as that. You don't need a degree to work that out. So let's just go into, there is a question. I'm just going to bring this up because I think it's related to property partnerships again. So, okay, so here we go. So is ICO better than FIC or trust for IHT planning? ICO won't be looking at inheritance tax planning just yet, but there is going to be an attachment of how you can use trust as a symbiote. That's a nice word. Not been throwing that in for a while. Symbiote. It will be added in. So is it any better? I think it'll be cheaper, more efficient, and more effective. Now, could I throw in more buzzwords?
Now stop it, because you're making people get very excited, and you've already said you're not showing.
I did say I'm not going to show. So would I be able to start a partnership with a spouse for property income if mortgages in one name? Okay. So if you're genuinely creating a partnership, it needs to be for legitimate reasons. Now, if you're a spouse, you might be better off to do either a partnership or to use a deed of trust. Now, use one of the QR codes or the links in the description box. Get some, John, please get some tax advice. There are so many ways that we can help you mitigate Section 24 and indeed the Rachel Reeves, the different tax changes. You know, that's what we put these QR codes on there for. We're not going to be able to answer it all in here. We can give some guidance, But really, if you want specific advice, you need to really get that done. Okay. I don't think there is anything else. So let's just go on for the last
9 minutes
third
we have. 9 minutes of your wonderful time, people, and we're looking to keep basically dealing with this.
Yeah. Tax on the wealthy. Let me pick this one up. So reduction of ISAs from 20,000 to 12,000. It's not really a reduction, my understanding. What it basically means is that she was trying to say, we're good to allow you to invest anything of that 12,000. But the 8,000, I believe, was trying to reinvest in the UK, is what I got.
So yeah, this is the thing, that the way I got it was that then the value that you can invest into ISAs every year hasn't changed. It's still, as an adult ISA, £20,000. What she's saying is, I'm going to take away your ability to put the full 20,000 into a bank ISA. So in other words, an interest-bearing account. I'm going to limit that to a maximum of 12,000, which means if you do want to make that full 20,000 investment, 8,000 has to be in something like a stocks and shares ISA, and the rest could then be in a bank ISA if you preferred. Equally, if you want to do all 20,000 in a stocks and shares ISA, you can do that. The only bit that's limited is how much of that ISA money you can put into a bank account ISA.
Okay, good point. So there are some additional taxes. Let's just run through those two. A council tax, an additional council tax is coming, attacking the wealthy. So if you've got a property portfolio of £2 million, then you'll be expected to pay £2,500 per year. Now, I did watch a YouTube video where they're saying if someone can afford £2 million worth of assets, then surely they can afford 2,500, right? Now, for me, someone with 2 million may be asset rich, but cash poor. So having someone with a £5 million with an extra tax bill of 7,500 may not be that easy to pay off. They may be just very asset rich. And there's a lot of people like that where they are cash poor. They can't afford all these taxes. A bit like farmers, right? They can't afford to pay IHT, even though they've got all these assets. So, these extra taxes are going to hurt some people. And to be honest, most of these people, like Louise and I, will bugger off to Spain or Dubai. There's a lot of people already leaving. Where are you going? Why don't you type in a box? If in this comments box, where would you move to, given everything you know about the Labour Party and the way that the UK economy is going, which, by the way, Rachel Reeves said, oh, well, the UK economy is going to grow to 1.5%. Wow. I'm so impressive, Rachel. After all this time, 1.5%. Let's be fair about it. India is doing better. China's doing better. The United States is doing better. Spain is doing better. That is not impressive, Rachel. Sorry, you should be really disappointed and gutted about your poor performance. I'm not going to get off my soapbox about that. I think she's bang out of order and she's incompetent in every level. Anyway, I'm sure the ATT will send me an email about that comment. So anyway, rant is over.
Don't get him started, people, please.
Oh, geez. Right. So last bit is pensions included in IHT from April 2027. We know that's going to take place. So again, we are just attacking the wealthy. And the wealthy, I think the 7th richest person in the UK has also just announced that he's leaving. So
shocker.
Yeah, right. It didn't take long to realize that was going to happen. Okay, so Louise, why don't you take this, because the dog's now out and about, and he's going to be...
The dog's very excited at these opportunities.
Yes, he is.
So invest, and I'm going to repeat some of the key things from this because they are so important, and people are perhaps not taking advantage of everything that's out there already. ISAs. Invest using ISAs when in personal name. Max those out before you start investing in taxable types of income investment actions. Please don't forget to use your ISAs because they are there, and there's a relatively large amount of money you can put in them before you max them out every year. Which one do I press to make sure I don't go backwards? Right. Okay. Invest in pensions. There is still tax relief for the corporate member, if you like. So your employer organization still has all those wonderful tax reliefs available to them. Take absolute massive advantage of that. If you can afford to put it in your pension, do it. It's a double win. A, the money is now safe in a tax efficient wrapper for now, and B, you're bringing down your corporation tax rate. And again, to my point earlier, if you don't understand why that's the case, definitely book some time with us so we can explain that to you. Invest via an ICO. I know Simon is not telling you anything about this. It's like a very bad game of charades, I appreciate, but it's going to be amazing next year. This is an opportunity for you. Lick your wounds, take advantage of everything you can, and prepare yourselves for ICOs, because I think this is going to be a real game changer. And then finally, transfer assets between spouses and civil partners. If there is a tax differential between you and your partner, take maximum advantage of that whilst it lasts, and stick one in the eye to the lovely Rachel Reeves and her team who are trying to take it all away from you. Don't let them.
Okay, can I get that back just in case? Okay, so ask your questions. I don't think there's many questions. I think people are talking about, there is one question. Let me just go to that now, and I'll bring that up. People are listing questions. So people are saying Portugal, Dubai, Malaysia, New Zealand. Please continue the rant.
You're going to buy an island. If it's in the sunshine, I want to know where it is, please.
I did try and restrain myself tonight. So what's the other one? So Cameron, it's something you said actually earlier. And those mansion taxes are on top of the existing council taxes for these properties.
And they will be positioned at the owner. They will be positioned at the owner. And what shocks me, if you're already familiar with a piece of tax legislation called ATED, you'll already know that you are being taxed on properties over $500,000. This is going to add to that. So unfortunately, this is going to affect you whether you're in a limited company or not. ATED is very specific to limited companies, and there's all sorts of ways to deal with that normally, and that's where a tax advisor like us can come in and really help you on that. But my goodness, you know, if you're going to feel the brunt of ATED because you haven't tax planned for it with someone like us or us, then not only are you picking up council tax, you're now picking up ATED tax, and now you're picking up this.
Right. We've got 2 minutes to wrap up. Let's wrap this up. So passing tax income to tenants in rent reform. So we know rent reform came in. Now, one thing about that is you are allowed to increase rent once per year. So yes, it may be a delay, but one thing I would be saying to many people, when's the last time you increased your rent anyway? I asked this many times to clients, when's the last time you've done a rent review? Oh, I don't want to, they're good tenants. Well, the next person might be a good tenant. Oh, yeah, but they've been there a long time. What, 8 years? And you've still not increased the rent? Come on. So I think there's a lot of opportunities in this that you need to think about. One other question I want to say is, can you transfer assets, transfer to kids? Yes, you can. And that's when that tax call that we showed on screen, also link in the description box, would be very useful. In fact, I might just leave that on there, just so you've got that on your screens. Because this is the last slide anyway. But in terms of, so someone's asking about ICO, Information Commission Office.
No,
not quite. No, not quite.
There is an ICO, but that's not as good as our ICO.
No, there's garbage. Okay, so the other one was the next one above it, which was, is the mansion tax for a single main residence property or a combined value of buy-to-let property? I think it's just one value, isn't it? It's just for the mansion tax, not properties tax. So I think it's just on the one. But hopefully this has been useful, guys. Maybe if we could just type in thanks, hit the like button, share. In fact, one thing I would ask you is, if there's a share button on this, if you feel that this has been useful and there's other landlords that need this advice or information, please press the share button and then just share it, whether you do that on your phone. But there must be one person you think, yeah, that one person really needs this. Send it to them, because the more we share this information out, the better. There's going to be, I'm still amazed that I speak to accountants or clients that have left their accountants and they haven't even told them about Section 24 properly. It just boggles the mind. So this information, we're bringing it to you right now, immediately after the budget, so we can help you. But your accountants, if you're all with the kind of general accountants, may not be watching the budget, maybe looking to retire with all the MTD stuff. So hopefully that will do us for tonight. But thank you ever so much for joining us.
Thank you so much. We weren't actually going to put together an offer for tonight. We were so incensed at what they've done. We've made an offer that we've never made before in terms of for new clients. For current clients, we are going to be sharing that stage 2 beat the budget. And stage 3, of course, is a personal review, which is part and parcel of your service. And we really want you to take that up. But we were so incensed that for those of you that are not current clients, this offer probably will never be repeated. But it's based on the fact that we were absolutely furious with what Rachel has done. And we want to protect you guys as much as humanly possible.
Sorry, Rodders said, thanks for not bothering to answer my question 3 times. I didn't even.
No.
Yeah, so sorry, Rodders. It hasn't even come up on my feed, so I don't know what your question was. Right. Was there any IHT changes? No, apart from the pensions in 2027, which I think we said in the previous slide. So, but there is no other IHT. So sorry, Rodders. Don't be upset. Hopefully we've answered that though there in that question. Okay, guys, thank you ever so much and see you all again soon. Bye-bye.